Hit it.
It's Friday, May 19th, 2023, episode 213. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, we have the pleasure of welcoming back to the show everyone's favorite Jim Leitner. We go over his epic trade from last year, talk about new opportunity he sees in the macro landscape, and how he is using AI in his investment process. After that, it's time for Patrick's Talking Charts, where he reads the market tea leaves and goes over the top 3 things to watch next week.
We're going to end with the no stupid questions and skin in the game. And folks, we might even drink some beers along the way. Lena, hop on. What beer are we drinking today?
So today we are drinking Elora Brewing Company's Lady Friend IPA.
Ooh,
So
that's good.
So this bear punching, thirst quenching, juicy IPA has a firm bitterness and a big body. It has bold notes of sweet papaya, ripe melon, and young spruce tips, balanced with a round malty character and firm bitterness. This IPA is not for the faint of heart.
I'm glad she read that and not me.
I agree. All right, Kev, give us the side effects, buddy.
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. Side effects of too much Huddle may include the debt ceiling dementia, artificial intelligence attention deficit disorder, NVIDIA nosebleeds, and then a little, we have a fourth today, an extra add-on, gloom, doom, and mega cap tech boom.
I don't know if that's a side effect.
Yeah.
It sounded good, though. All right, let's get to the interview with Jim.
It's our great pleasure to welcome back to the show Jim Leitner. Jim, thanks for coming back.
Kev, I love hanging out with you, and I wish we could do this more often.
So I was having a look, and the last time you were on our show was May 13th, 2022, almost exactly a year ago. Yeah. And back then, I just want to kind of remind people where we were. The Fed had just started their hiking cycle. But a lot of people thought that they wouldn't go that far and that as soon as they raised rates, the economy would roll over. The Fed funds were 1%, but you were there and you were suggesting that the Fed might end up being dramatically more aggressive than the market had priced in. If I recall, I think you suggested that it might even go up to 5%. And look where we are now. We're 5%. This is obviously a real home run of a trade. Jim, I can't tell you the number of people that I meet out on the street or when I go visit people and they say that Jim Leitner, he just had the trade of the decade or the century when he came on your show and he talked about this. It was absolutely outstanding. I'd love to just kind of get an after the fact analysis of this trade. And I'd love to hear how it played out from your end. Did you have any trouble sitting through the gains? Were you tempted to take profits along the way? Just kind of any color that you'd be willing to share with us.
So I did a really terrible job in 2022 because I ended up caretaking. I ended up moving down to Taos, taking care of my father-in-law, taking care of my mother-in-law, taking care of just so many things that really the positions ended up being way too small. And taking off way too early. I think this was one of those macro events that people made their lifetime on, and I didn't. I mean, I just totally underperformed, which was kind of sad in retrospect. But what I love about this business is that there's always another train leaving the station. You can look back and kind of go, boy, did I miss many good trades? Even when you had a good idea and you felt that you had thought it through, there are often things that just happen in your personal life that just drag you away from doing the right thing.
For sure.
I think, last year, the clear thing was, number one, to me, rates were going to go higher than the market seemed to expect. But the other interesting thing was that none of that was reflected in options pricing, right? You could buy really cheap optionality and just put it away if you wanted to do 1 year Eurodollar futures. You should have made 100 times your premium. I mean, it was a home run opportunity. And, some people made home runs, and I'm really happy that happened to them.
You've had your share of home runs, and not only that, sharing with everyone was a home run in itself. I recently read David Tepper talk about how one of his great regrets was in 2000 or late 1990s. He got bearish on the stock market and he got himself talked out of the trade by his investors. and he views this as kind of one of his biggest disappointments, or one of the trades that he most regrets. Do you suffer from that as well? Like, when you look back at your career, do you think that the ones that you didn't make everything you could have end up hurting more than the ones that you actually just got wrong?
For sure. That's such a good observation. I hadn't thought of it. I mean, I read enough psych literature, and you always read that losses hurt you twice as much as profits make you happy. But losses, or opportunity losses, opportunity costs, actually hurt you in the same way twice as much as your profits make you happy. So for me, that was actually a really big trade during the Asian crisis in 97, where I had bought an enormous amount of 1-year dollar Korea calls really cheaply when the volatility was super low. It hadn't moved. It was trading around 850, and it moved up. The spot Korea moved up towards 900, and the broker who had called me and said, this vol is too low, called and said, oh, it's definitely time to take it off. And I just kind of thought, okay, we made decent money. And of course, 6 months later or 8 months later, when the options matured, we were trading at 1,400 on the Korean won. And that would have turned into something like a $700 million P&L. And instead, it was in the millions, but nothing that you want to write home about. And, I often think back to that one and think, that coulda, woulda, shoulda.
Did he want to get it back because the people on the other side that were short just wanted the vol back?
I'm not sure. I
really, or he just wanted the commission. He was just a broker wanting the commission.
Probably. But, it's always up to us to decide, are we going with that flow or not? And when should we take it off? And, I should listen to my instinct, which was, I was super happy to have a very large position, probably one of the largest Asian currency positions I've had in my lifetime. And then I just kind of like walked away from a massive opportunity. Well, anyway,
when you sold that, you kind of took it all off. Do you have a kind of a tendency now, as you've gotten older and more mature, or not mature, as more wise, to peel some off? Like, you don't have to sell it all?
Yes, definitely. So I think nowadays, I use many more we call digital options, and we've discussed those in the past. Those can be replicated with very tight call spreads or put spreads, and they basically reflect the probability that the market assigns to something happening. And I tend to buy options, let's say they cost 15% of the payout. When I'm right and they trade towards 50%, it's not the same bet anymore. I wouldn't go out and spend 50 cents to make another 50 cents. I'd have to be incredibly certain that that was going to happen. So when it gets towards 50%, I tend to start peeling things off. Very seldom do I hold these digitals till they actually get to 100. Okay. I wouldn't say I never do, but I would say that maybe 80% of the time I peel them off starting at 50-ish, whether it's 45 or 55. And then as you continue to be correct, and maybe you're earning positive carry, or maybe the spot market keeps moving in your direction, you just keep peeling things off, because you wouldn't buy the option there. So part, I think, of managing risk or exploiting the position that you have on is to reduce them when they're not at the kind of level that you were willing to put them on at initially. When you have a bunch of profits, it's just not the same trade anymore.
Right. Do you sometimes peel some off with a delta of 50, or not delta of 50, with a premium of 50 there, and replace them again with something where you might have a 10-to-1 payoff profile?
Yes, definitely. But, it really just depends on your forecast.
Right.
So what you need to do is you mark your book to market, and now it's trading at 50%. You take some profit, you reduce the risk to the kind of level that you now feel comfortable with holding on your books. And then you look at the same instrument and you say, what is my forecast today for where this is going to end up in whatever, X months. Let's say you had initially bought yourself a 1-year option. 3 months later, it ends up being a 50-50 option. What do I think is going to happen now over the next 6 months, 9 months? Do I think it's going to continue going higher? How much higher? One of the things about options is it's very clear when you're right, because in order to be right, you need to get the direction right and you need to get a maturity right. Frequently, I hear people say, oh, like the euro is going to go up next. And you kind of wonder, well, over what time frame? And when you have to put your money down to buy an option, it forces you to think about the time frames. So, once you've peeled things off, you can easily go back and say, okay, now what do I think? I'm peeling things off here because it's not the kind of bet I'd want to spend 50 cents on to make 50 cents more. I mean, doubling your money is nice, but really when you paid, let's say, 20% on the option and now it's worth 50, you just made 150% on your premium.
Now, how do you kind of I think back to the Bitcoin story, and sorry I stumbled a little there, but I'm just trying to think how to word this. Your Bitcoin story, you had actually bought it and you sat through an enormous move when it became a large portion of your portfolio. And one of the things that I thought to myself was like, holy smokes, I could never do that. I would never have the ability to do that. And yet you really kind of argued that was the way to make big, large outside gains. And yet here we are, and we're talking about the digital options and how you'll peel some off. Just kind of, how do you reconcile those two different strategies and two different thought processes?
So on digital options, you cannot really make enormous outsized gains, right? Let's say you're paying 20% of payout and it goes to 100. You're going to make 5x.
Right.
You're not going to make 50x. You're not going to make 30x. It's a totally defined bet. If the spot continues to go in the direction that you had forecast, you just don't make extra. You're basically, by using a digital option, given away the tail upside.
Okay.
But if you just buy a regular call or you buy a stock, right, then you have infinite upside because crazy things can happen. So look at in March when we had the banking crisis. So the first bank that blows up is around March 8th.
Right.
If you had become a little bit nervous that day, you could have spent one tick on buying Sofra, the SFR June 100 basis point out of the money calls.
Okay.
And just said, you know what, I don't know if this thing can turn into a banking crisis or not. A friend of mine actually did buy some. That was on Thursday. On Friday, we had Silicon Valley Bank problem. And then on Monday, these options were trading up to 120.
Really?
So my friend took his profit around 75. Now, if you had a digital or a call spread, you would have done okay because it would have blown through your call spread, but you did not get that extra tail. And so, when you remind me of the Bitcoin story, it's true. I didn't want to give away the upside tail. I wanted to hold on to it because I said, this thing called cryptocurrencies and Bitcoins, I just have no real way to value what that could be worth. And owning it without a maturity, knowing that someday it's either going to be worth zero, but it could also be worth an enormous amount.
Right. I
was willing to sit through very large P&L swings, up and down. I mean, it felt great when it was an upswing, and it didn't feel so good when it was a downswing.
Right.
But, when I look back, I don't think it was a really large mistake because I didn't want to give away that tail. So I think, initially when you do think about the macro risk you want to put on, you have to think about, is this the kind of risk where I want to have tail risk long on my books where really big things can happen? Or is this one where I just kind of think, the euro could be higher, 3 months from now. And, it's maybe we're talking 2%, 3%. We're not talking it's going to be up 50% suddenly.
And when you think about your portfolio, are the majority of them those defined risk like binary trades or digital trades?
Yes, I would say that if I look through the entire portfolio, it's probably like 80-20. 80% very defined, digital, call spreads, digital options, things that can make you 5, 6, 7 times your money. Sometimes, you buy things that are like 20 times your money. You pay 5% of payout because somebody's willing to sell you something that you think is just really way too cheap. But again, you still have given away the tail. And then the other 20% are things where you say, I really want to keep that tail because I'm just not certain how much things could move. I mean, we could talk, for example, about the debt ceiling.
Okay, let's do that.
None of us have a real clue what could happen in June, right?
Okay.
I mean, we don't know how much markets could move. We don't know if there's going to be an agreement. Let's assume there were no agreement. We get to the end of May and the Treasury is facing actually not having enough money to pay the debt that's maturing. Now, what happens? Either we default, not very good for yields, I would think, although who knows, maybe in a crisis like that, the Fed steps in and just buys bonds because they know they can hold them and they'll get paid back. Or, they come up with the 14th Amendment conclusion, which is we're just going to continue to issue bonds. We're just going to continue to issue and let the Republicans take us to court. Maybe the courts will just refuse to take this case and say it's not justiciable. It's a political question. It's up to you guys to figure out what you're going to do about it. In which case, I think two things will happen. Yields on the newly issued debt for a while will certainly be higher until you get a statement from the court that they're not willing to take it. And the other thing that will happen is that volatility will be a lot higher because people will just not know what can happen. So if you look at the MOVE index, which is the index that measures fixed income volatility, it's trading around 125 right now, or 1.25. And that's basically the average for the entire 1 year picture. If you look at the period in March when we had the beginnings of this banking crisis, that MOVE index spiked up to 200. So let's assume that we feel that it's more likely than not that yields on newly issued debt would be higher rather than lower.
Right.
Okay. So what does that do? Well, that means that now we have a new 10-year bond that's yielding X basis points more than old 10-year bonds.
Right. Actually, why don't we back up just a little bit and explain to people what you were meaning by just the government issues through the debt ceiling and just says, I'll see you in court. Let's just talk about that a little bit, about how that might work and what it would look like.
Sure. So, I mean, if I were in the administration and I had a Republican Congress to deal with that said, look, I will not allow the debt ceiling to be raised unless you do a whole bunch of things that are totally antithetical to the Democratic administration, which has no interest in really hurting its own base. And I said to Congress, well, the last law that you passed was the budget. The budget was passed a year ago, and under that budget, I am supposed to do certain things, which means I need to pay for them, whatever those things are. It's like paying Social Security, it's paying the interest on the debt, it's paying corporate suppliers for weapons, it's paying the people in the in Congress, paying people in the federal government. So that budget was passed last year. That's the law on the books. If I don't pay it, it's kind of like saying, I'm supposed to go out, spend money on my credit card, and then turn around and go, oops, I'm just not going to pay off my credit card. But, we have the 14th Amendment that says that the debt of the United States shall not be questioned. And in the 14th Amendment, which is directed at Congress, it's very clear that basically the debt of the United States of America is considered sacrosanct. There's certain exceptions to it. It says that, debt that was issued for rebellion against the government is treated differently. So, in general, the kind of debt that we have, according to the 14th Amendment, needs to be paid. So if I'm the administration, I say, look, I'm happy to negotiate about the next budget. That's going to happen in October. But we're going to pay for the things which you have told me to spend money on last October. We're not just going to walk away from our debts.
Right.
That's just not how the American political system is set up. And, if you guys don't want to agree to that, then I will just continue to issue the debt. I will go to the market. I might have to pay more interest because people will question whether this debt is as secure, because they might expect you to go to court. All kinds of things could happen. But that debt there will be somebody who will be willing to buy that debt.
Right. So the Treasury could just issue through the debt ceiling and say that this is our obligation under the 14th Amendment to pay our bills. And so therefore we're going to issue debt to pay so that we pay our bills and issue through it. And then it's up to the Republicans to sue the Democrats. Is that correct?
Well, to sue the administration.
Right. Okay. Sorry.
That you can't do it.
Yeah.
So then, of course, you need two things. You need the court to say, well, this is a case that we will accept, because there is a thing called the political questions doctrine.
Okay.
And they don't have to accept every case. And the other thing is that in order to bring a suit in the U.S., you have a thing called standing, which means you have to show an injury. Now, I find it hard to see what Congress can say about being injured.
Okay.
By paying the debt, by paying your T-bills, by paying your salary.
Yeah.
How did I injure you? They might not make it on standing grounds. They might not make it on political questions doctrine. I think, if I were the administration, I would take that chance. If it came down to, you don't want to sign a debt ceiling bill between now and June 1st, 2nd, 3rd, whenever we actually run out of money, then I will just instruct the Treasury to continue to issue debt as if there had been a debt ceiling bill, use the exact same schedule, and see what happens.
Okay, so they issue these new bonds, and so the new bonds are what you were arguing is that there'll likely be a premium in terms of yield, like a discount in terms of price, because people will worry that whether these are as secure as a previously properly issued bond.
Correct, and we see that already now on T-bills, right? Because we have T-bills that mature later in June and are trading at like 538 at 20 basis points above SOFRs.
Right.
So the market is already starting to imply a risk premium to things that are happening in June. And we haven't even hit the real problematic case yet, where we actually run out of money and then something happens.
Right. Okay. So we have these bonds. They'll be issued at a discount. And let's just imagine it's 20, 30 basis points, something like that on a 10-year. And you're, or even worse, like I probably shouldn't put words in your mouth. What do you expect that discount to be?
Well, I would think that it would be at least 25 basis points.
Okay.
It could be more. I wouldn't be surprised if it was more. I think that we'd go through an incredible volatile period where people would try to figure out what that discount should be. We'd have to see what people were willing to pay, in order to give money to the Treasury. I mean, what kind of return would they expect?
Right. Now, going back to your portfolio composition and not getting rid of your tails, I think you were going to say that this would be a case where you wouldn't want to use a digital and you would want the open-endedness of just one leg.
Right. So here, for example, I'm long puts on the 10-year struck at 111 that mature at the end of June.
Okay.
So, I think that they might go to zero, but crazy things can happen. The volatility could double. That would by itself be a big win, and yields could be significantly higher than what I think they might trade to.
Right. As we've seen also like during the UK crisis, bonds did some just absolutely insane things that really, according to models, should have never happened.
Correct. Yes, exactly. So, and the UK thing was really a liquidity issue. It wasn't even an issue of sovereignty and whether those gilts were legally actually debt to the UK government or not. So I think if you add all those other political questions to it, it could make the gilt episode look tame. And the gilt episode was really pretty wild.
Right. Now, the U.S. CDS market is trading with roughly around a 4% chance of the U.S. defaulting, doing a technical default. Do you think that is wildly underpriced?
Yeah, I think that it's probably higher than 4%, honestly.
If you were forced to make a market, like what would be your bid offer on that?
Well, I would say that it's probably more in the 25 to 30% range.
Oh, you're that high.
I mean, I think that the Republicans really have boxed themselves into a corner. So, there might be a political solution with this discharge resolution that the Democrats are trying to pass in Congress, and they're hoping to get a couple of centrist Republicans to sign on. But those are all long shots. I just don't know how this is supposed to get resolved. And then today we had the news that the Republicans have said they've stopped negotiating, because they felt that the administration was not coming back with enough counter proposals to their demands. So I think every week that goes by just increases the probability of somebody miscalculating.
Right.
And I think the administration holds the stronger cards, because I think the administration can just continue to issue debt.
One of the things that I find interesting about this whole kind of game theory is that the market is assuming that there will be a last minute deal.
Mm-hmm.
And therefore they refuse to change pricing in the market and panic. Yet the more that the market assumes that, the more like the different parties have kind of a desire to dig their heels in, because it doesn't look like the cost of actually going over the cliff for that big a deal.
Correct. I mean, that's the Soros reflexivity argument.
Right.
I mean, basically, because the market is so sanguine about what's going on, it allows the political parties to take an even harder stance, because looking at the market, they kind of say, well, the market obviously knows well that nothing bad's going to happen, because the S&P is still at 4,200 and the bond yields haven't moved very much. So it'll be even more surprising when something becomes a misstep.
One of the things that it reminds me of is, and I remember back when they first brought the tarp down to the floor, and the first time they did it, everyone was like, okay, they brought it down. Of course, they got the votes. There's no way it's not going to pass. The market starts to rally. And then we're watching the votes tally up, and it's like, oh no, all of a sudden there's not enough votes. And then they start talking. I distinctly remember this because I didn't understand the rules. They're like, oh, they can change the votes after the fact, and they can go and they can, get someone to move over. And so they're going to do that. And we're sitting there waiting for it. And then all of a sudden, boom, they hit it and they say it's failed. And I just remember the stock market going, holy shit.
The stock market, right?
Yeah. Market was like, holy shit, I can't believe they did this. And that's what I worry about with this, is that we might even get a situation where the bill goes down to the floor and it looks like it's going to pass, and then all of a sudden it just doesn't.
I agree. I mean, I think it would be a really difficult situation for the markets, and especially the treasury market. Yes, the equity market will get hit. All risk premium will go up dramatically, but this directly affects treasuries, right?
Right. Now, some of the people that I know and talk to will say, you know what? In the grand scheme of things, it's kind of a technical default. We all know they're going to pay it. There's nobody else to really take the place of the reserve currency. It's not going to matter that much. We're overblowing, just what in essence ends up being an accounting entry. What would you push back and say, no, this is actually could affect people's portfolios and it will cause them to buy and sell different securities?
I think there's obviously always a probability that they could be right. We shouldn't discount that. Forward looking, the world is just probabilistic. But treasuries are used as collateral against so many different things. And if suddenly the value of this collateral is being questioned, all kinds of things might need to be unwound.
Right.
And I don't even think we have a concept of what could move and how much mortgages could move and how much privates could move that, use treasuries as collateral right now. Or what happens, if your futures trading account has debt in it and your broker suddenly says, you know what, this debt, I'm not sure I can accept it as collateral because, we're not sure if it's good debt or not. And I'm being told that I need to inform you to close your positions.
Yeah. It would be a forced kind of credit contraction that is at a time when we least need it. Already, we're having problems with not enough reserves in the system and banks are finding themselves with not enough deposits. And this is the last thing we need.
Yeah, no, I mean, I bought these puts on the 10 years expecting that I'm going to lose money on them. But if I don't, we're probably in a really ugly world.
Right. And that's why keeping that tail open is so important.
Exactly. That's why you wouldn't do digitals or you wouldn't buy a put spread. You just buy some puts and say, I own these. This is protection. And it could pay off big time, just like you said about the gilts, where we saw enormous moves, or some of the other large moves we've seen in history. They just weren't always in treasuries.
One of the things that always kind of scares me when I see people talking about the gold trade, they'll buy themselves a gold, like slightly out of the money call, and then they'll be so excited that the skew is actually positively sloped in terms of the way out of the money calls. You get these great kind of implied vols that are much higher than the at the monies. And this is unusual because in a lot of time, or not unusual, but it's different than the stocks, because in stocks it's actually the opposite. Those trade lower. Mm-hmm. And so people are so excited about it and they want to do that trade. And I'm always like, don't do that. That's like you're giving away the right skew. And like, fine, if you truly are happy to make that sale of that gold, if it goes up there, then that's fine. But just ask yourself, if it does have a situation where gold goes up $1,000 in a week or something like that, how much you'll be kicking yourself.
Exactly.
Yeah.
No, I think that, I think you have to be very cognizant of when do you want to own the tails and when are you happy just to take probabilistically good bets.
Right.
Like if you think that there's something happening in, I don't know, the upside of Apple, it's not going to suddenly double within the next
although these days it might, Jim.
Or most currency bets, you're not suddenly going to see enormous moves. However, here, when you see the kind of moves we've had in interest rates, you should really think very carefully about whether you want to keep the tails or give the tails away.
Right. All right. So Stan Druckenmiller recently said this is one of the most difficult periods of his investing career. And he alluded to that he was just not seeing the ball. He stressed how in times like this, it's important to not swing at every pitch. So first of all, I want to know, do you agree with Stan that this is one of the more difficult periods for investors in recent memory? Second of all, do you struggle with the urge to do something? And if so, how do you deal with it? And finally, do you have any insights as to when this might get easier again? Or do you think this game is always hard, and if it's obvious, it's obviously wrong?
Oh, those are good questions. So I really think that it's hard to have a lot of bets on and be right lots of times. And when I look at my career, I clearly overtrade, and I think almost all macro traders overtrade. So trying to sit on my hands is probably the hardest thing that I do. When I think about the last 4 or 5 years of trades, there are always 4 to 6 ideas that really make a difference that you have high conviction in. And then there are lots of other trades that you end up doing that are just kind of a wash, or maybe they make you a little bit or they cost you a little bit, but they also take your mind away from developing the 4 to 6 really strong ideas that you hold on to, where you really want to ride the trend, or you think you really see the ball.
Do you think, though, that you need to be in those other little trades to get a feel for the market?
That's a good question. I think that you may want to be in some of them in option form anyway. But it's a question of how often you want to do that. So, you asked me, do I find it hard to not play? And I think I told you once that I set up a little trading account in London that I just put in a tiny, tiny amount of money.
Yeah.
That I can just click. It's just like doing a computer game that my kids do, like Space Invaders or something. And you can just click on all these different currency pairs and buy and sell. And it's not going to make any difference to your lifestyle because you just don't put enough money there. And if you really feel like, today I just want to play and I want to trade, well, you have a playground. And you can go into it.
That's a great idea. I forgot about that story.
You can draw little charts and you can say, like the euro just got to this level that looks really interesting and it's going to hold here. I'm going to buy some and then I'm going to sell them 5 to 10 ticks higher. And, so you can do that. And if it makes you happy, why not? I mean, happiness is really important, but it doesn't really impact performance. It's just kind of a distraction.
Okay.
Yeah, I think most of the time I spend 40% of my time trying to explore the world. So, we have enormous amounts of information coming at us all the time. That price information, politics, economic releases, all kinds of stuff. It's impossible to keep track of all of that, right? So what do you need? Well, you need curation. That's the first thing. So why do I subscribe to your Substack? Because you are a wonderful curator. When you send something out, I kind of almost always learn something new, or it confirms an idea that I've been kind of thinking about. And I follow a lot of people like that. I follow the Blind Squirrel, or I follow Alf Peccatiello on his TMC, the Macro Compass, or on Substack, you can find a lot of people like that. So I think curation is one thing that helps you cut through the noise. The second thing is kind of the science of looking backwards. So we know that carry works in general, right? Like over long periods of time, carry is an important component. But like actually really tracking it and saying, for the last 3 months, classic carry, which is being long the 5 high-yielding currencies in the portfolio of, let's say, 28 currencies and short the bottom 5 lowest-yielding ones, is up 10%.
Ah.
That's pretty amazing, right?
Right.
And then you can look at it volatility adjusted or equity market adjusted, and you can look at this portfolio and say, well, what currencies are moving in and out? And that gives you information because it tells you what you should look at. So when Brazil moves into its high return and volatilities have come off enough that it shows up in the carry basket adjusted for volatility, you know that there are going to be more people who are going to say, ooh, this is an interesting place. I'm earning really good carry and volatility has dropped, so I should be focusing on it. Or if on the liability side, you see CNH suddenly starting to show up, well, then you focus on China and you say, well, what's going on here? Why is dollar China starting to move up? Is this something that's systematic? Is there some deeper reason to it? It gives you information. So looking at history gives you information.
So can I ask how
Um,
you do that? Like, do you use sell side research? Do you use your Bloomberg? Do you create your
all
own?
of the above, but I kind of know who's good at it. So,
Okay.
for example, on the carry stuff, I look at Macro Hive.
Okay.
Bilal Hafez.
Yeah.
He has this nice little thing every Wednesday, like 8 different models of how one could earn carry, how they've done over the previous week, how they've done over the previous 3 months, previous year, and what currencies are moving in and out. And
Okay.
so that to me is like one-stop shopping. I look at it every Wednesday. It just kind of gives me some information as to what I should focus on. Or correlation, right? When we see correlation changes, correlation asymmetries, it's a similar story. So, Macro Alf, Pecatiello with the Macro Compass on his website has a little thing where he looks at all the correlations, and you can look at 1 week, 2 weeks, up to 3 months of a large number of currencies and assets against each other. And, when you clicked on it this morning and you look back a week or 2 weeks, it's kind of had as a top asymmetry the Nikkei. And I looked at Nikkei against the Russell 2000, Nikkei against a whole bunch of different things where Nikkei should not have gone up.
Right.
And then it looks at what kind of standard deviations are you away from the historic correlation? And if it shows up on like 8 different parameters where you have Nikkei against 8 different things, and suddenly this Nikkei has just done so much better than what it should have done based on correlations,
Yep.
well, you better wake up and you better start saying, what's going on in Japan? What is happening with the Nikkei? Or, a couple of weeks ago, it was Poland. Poland had 11 correlations that were more than 2 standard deviations away from what you should expect given 5-year history.
Okay.
Okay.
And you
Well,
actually traded that one. Can you talk to us about what you did there and how it worked? Like how you noticed this and what you did to take advantage of it?
sure. So Poland to me, super interesting. I started looking at it maybe 2 months ago when I heard for the first time that 3.8 million refugees from the Ukraine had come into Poland. And somebody said to me, do you know how many refugee camps there are in Poland? And I said, actually, I don't know. I haven't even thought about it. And his answer was 0. The civil society just took in these 3 to 4 million refugees and placed them.
Oh, wow.
People would take them into their homes. People would find them places to live. People would find them jobs. I mean,
That's shocking.
to me was incredibly impressive. I mean, that was
Wow.
10% of the country. Poland had 38 million people,
Yeah.
and they're taking in almost 3.8 million. So, as I was thinking about that, I said, I wonder what else is going on in Poland. I realized Poland has underperformed the rest of Eastern Europe because the Polish government has been very anti-European. And so there are these rule of law issues, and the European Union has held back 30 billion plus of grants and loans that were given out during COVID, but not to Poland because Poland was doing all kinds of things with its judiciary. And as I was reading more about Poland, I saw that the election for the next parliament and prime minister happens in the fall. There's no precise date yet. It's just sometime in the fall. And I looked into the polls and I saw that the opposition is running very close to the current government, neither of which has a majority. They'll have to do a coalition to form a new government. But the head of the opposition is a politician named Tusk, who was a president of the European Commission.
Okay.
Now, imagine how close he is to the Brussels bureaucrats and to the Germans and to everybody else in Western Europe compared to the current government. And I realized that if he were to win, and if the opposition were to form the government, the Euro Poland would drop dramatically. I mean, Poland would just suddenly become a place where Europeans would want to invest. You know, Poland's done some things very nicely with the Ukraine. They've been very helpful. The US likes them, NATO likes them. It was just this relationship with the EU in economics, in the rule of law, that's really held Poland back where it is today. And if that were to go away, we would see a huge boom in Polish assets. So I bought some Polish stocks and I bought downside options. So Euro put, Polish call, digitals.
Okay.
And the volatility was super cheap. So you could get 10-to-1 type of payouts with very reasonable strikes for 9 months, 12 months. You want to go past the election. The abortion issue in Poland is raising up the young people to become more politically active. We saw that in the US. Poland has very strict anti-abortion laws. Again, young women feel that they need to go out and vote to make sure that that gets changed. And we saw that in the US, when abortion is on the ballot. Here, Republicans lose. In Poland, I think the PIS loses. So I think the probability of the opposition being able to do better than people expect is higher than what the market polls are telling us.
And you found all this and you saw it in the market first with the correlation, meaning that the Polish assets were outperforming and therefore correlation was changing?
Well, I first saw it just by reading randomly about Poland.
Okay.
And then I saw the confirmation of my thoughts by looking at correlations and saying, this is kind of crazy how these correlations are all breaking down.
Okay. And that gave you the confidence to go and say,
to be bigger.
Okay.
It's kind of this idea that, let's say you have a bet that can lose you 100, which is the premium you put down. You lose all of it. It goes to zero. But on average, you've paid 20% and it's going to be worth 50% when you sell it. So you're going to make 150.
Okay.
Right? So that's your downside's 100%, your upside's 150%. Let's assume you were 50-50 certain about this bet. It was just a coin flip. How much should you bet on this bet?
Right.
Well, there was a guy named Kelly who put together a formula that tells you what the correct amount to bet is. And if you put in those parameters, you're 50-50 on a certain bet and the payouts are minus 100 plus 150, then the correct amount to bet is 16% of the amount that you're willing to play with.
Right.
And to me, that's the amount of money I put into premium. So I did not go and put 16% into this bet immediately. I said, I think this is interesting. I'll put 2 or 3% in. Plus, if I have lots of other bets, I'm starting to look at what kind of correlation is there with my dollar Brazil downside bet, or how is this going to be impacted by risk off if we have a problem with the debt ceiling, etc. So I start smaller, and then as I get more confirmation, as I start seeing correlations working, I increase the bet. And I do think the correct amount to do is like a half of Kelly to a full Kelly bet.
Really? Because Kelly can be quite big at times.
Yes, Kelly can get very aggressive.
You're definitely playing 1980 style macro, hedge fund gurus when you're going full Kelly.
Yes, for sure. But the thing is, when you're using options, Kelly does not get totally crazy because you're putting in that you can lose 100% on one side, and Kelly will never let you go bankrupt.
That's true.
So you never take leverage. Kelly will not let you take leverage if you tell Kelly that one side of the distribution is minus 100.
Right. Oh yeah. No, that's a good point. You're right that Kelly is different when you're dealing with options. And
Well, I
not only
think,
that,
in
the
general,
options are
if you
always
run your portfolio at like 1/10 to 1/2 of Kelly and you have 6 to 7 bets, they all add up together to a reasonable number. And historically, I think that's kind of made me feel happy.
okay. Um, let's talk a little bit about AI. It's been all over the news. It seems to be. We just had Stanley Druckenmiller, Stevie Cohen, Paul Tudor Jones talking about how it's going to change the world, and disinflation is back, and big cap tech is back. I would love to hear your thoughts on AI, whether it's as transformative as they're saying, and what you might be doing about it in terms of your portfolios.
So I'm not really the right person to ask about transformative. I think you need really smart people for that. Um, lots and lots of interesting things will probably happen. And I hope they're things that we haven't even thought about. Kind of, like when the dot-com bubble blew up, nobody thought about what Uber was going to look like 15 years later,
Right.
or Airbnb. So I think with AI, it's probably very similar, that we can't even really imagine how transformative it's going to be or in which areas. But what I like about the AI is that it's already useful. You can already play with it. You can use it to help you think through the markets. So when we were looking at the earlier at how do you find good trades, there's something called toggle.ai. I don't know if you've ever used it.
No, I've never used it.
Oh, it's very, very cheap. And I think actually, if you have an account at certain brokerage houses, it comes for free with your account. Toggle.ai.
Okay.
Toggle.ai. It's a group that basically uses AI to mine historical data, looking for interesting relationships and suggesting trades. So it will look back in time and it'll say, when volatility in the Canadian dollar dropped by more than 22%, and at the same time, the stock market did this or that, 8 times out of 9, Aussie Canada went up.
Right. Okay.
Over the next 6 months. And it'll give you a little distribution of what the other 8 times looked like, and what if the past was determinative of the future, what the future might look like. And to me, it's been great in terms of idea generation. I think it's just great. You can put in all the kind of assets that you follow. They follow tens of thousands of assets. I mean, lots and lots of individual equities, which I don't really look at very much. Maybe I do at some of them, the large ones like Amazon and Apple, but I don't really look at all the stuff that they look at. They look at Japanese equities, German equities, US equities. But even if you just kind of look at macro and you say, I want to look at all the currencies, I want to look at all the interest rates, I want to look at equity indexes, it'll come back every night rerunning its database and saying, with today's changes, here are 5 new trades in the things that you follow. And then it's up to you to think about, well, is this interesting? Is it not interesting? And it's an AI-driven system that's improving all the time. And I think they've done a super interesting job. The other thing I'm doing is I'm working with a group of programmers on an advanced version of ChatGPT, reading the news and trying to understand kind of a higher level of sentiment. When people talked about sentiment in the past, it was very rudimentary. You'd have good words and bad words. And you more or less counted the good words in stories and the bad words in stories. And if there were more good words, then the sentiment was positive. And nowadays, with ChatGPT, you can do way more in-depth analysis. And we are using that initially just on stories in the crypto markets, because we feel that that's much more compact. It's much harder to follow the whole world. If you can show that you can do it on a small subset of stories, and it helps you identify trades in the crypto markets, then you can expand it to macro event trading and start reading, all the stories in the Financial Times and Bloomberg News, and then. The other thing is that makes life pretty easy, asking it interesting questions. So if you ask ChatGPT about, like what did the US stock market do 1 year after the last time that the Fed raised rates? It'll come back. And first it'll come back with some kind of, in 2018, this is what happened. And you have to go back and say, no, what I want is a matrix that goes back to 1950 and looks at every single occurrence where, the Fed raised rates so many times and then stopped. And the next move was a move down. And what did the stock market do 1 year after that last raise? And then you get a distribution. He'll say, on average, the stock market was up so many percent. And here is the table. It happened in 53, and then 57, and then 62, 63, et cetera, et cetera. And, that's a really easy way to do research. So when you have an idea, it's great to be able to ask the question and get a reasonable answer.
Do you worry about that, back to the Soros reflexivity? And the fact that as we get quicker and quicker about all these things, that we're making the market cycles faster and faster, and that the signal will eventually kind of almost be negated because we're so fast?
Yes and no. So the yes part is that I think trading will become harder, but not investing. So thinking about that Polish election in 6 months, right? That doesn't get any easier whether you have AI or not.
Okay.
Right? Having big picture ideas and big picture thoughts about, is Bitcoin one of these unbounded assets where I really don't want to give away the upside? Whether I have AI or not, it's not going to answer it to me. I think it'll be more and more interesting asking interesting questions over a longer time frame, and it'll be harder and harder to trade new information that's arriving. And we've already seen that without AI, as markets became more efficient, as there were data releases on XYZ, on inflation or on GDP or on, what used to be money supply in the old days.
Yeah.
The markets would now adjust within half a minute. You see the futures move, and that's it. Boom.
Well, it's even faster than that, because now there's machines reading it, analyzing it, and doing trades based upon that. Sometimes they get it wrong, and obviously it's not as cool. But in our day, we used to sit around reading a headline and then go, okay, now we should buy it because of that. But now there's a machine doing that.
Exactly, and I think that part of trading is going to become more and more automated, more and more difficult for humans to participate in. So what we need to do is extend our time frames.
Okay. I get it. Right. As it becomes more efficient over the short run, it just means that we'll have to go take advantage of the longer time frame trades.
Right. Because nobody actually systems are not set up to take longer time frame bets because other risks show up during that period of time. I mean, the systems are set up to trade very quickly on new information very well. So you can't beat them. You might as well just walk away from them and not compete. Try to do something where you have a 3 week, 3 months, 3 year time horizon. And now you're not competing with anybody. Now it's just basically, are you right or are you wrong? Like take the Indian rupee today. It's trading at like 82.80. A 3-year option, a digital option, that the Indian rupee will be at 82.80 or stronger. So the dollar rupee will be lower, costs you 16.5% of the payout. So it's like a 6-to-1 bet, right? If nothing happens for 3 years, you make 6 times your money. Well, you're not competing with any system. Now it's just up to you to think about what's the probability. Is it really 16.5%? What's the inflation rate? Why do they have a current account deficit? How much of it is driven by manufacturing trade? Now that Apple is starting to build factories, is manufacturing trade in India going to change compared to what it was over the last 3 to 5 years? How's the Indian government approaching manufacturing trade? What's happening with, Russian uh, discount oil sales to India? How much is that going to affect the current account deficit, et cetera, et cetera? So I think at that point, you can use your imagination to think about what might be a really good bet rather than just using AI to come up with, like in the on the next release, what is going to happen.
Jim, one of the things as we've chatted today, I've noticed that you've brought up a lot of currencies. Do you think that we're in an environment where there's more currency opportunities than stocks or fixed income? Or is that just your
question? No. I think it's actually true. I think there is more multipolarity, which means instead of thinking about the US or thinking about the US and China when it became really twofold polarity, instead of a unipolar world, we had a bipolar world. I think now we're in a multipolar world where, countries in the global south are basically saying we're looking out for ourselves. And you will have to spend a lot more time trying to understand idiosyncratically, country by country. So you have to understand what's going on in Brazil. You have to see that they have done a really good job on inflation, better than the Fed did. You have to look at Chile as the largest copper exporter in the world. You can look at Indonesia and see what they're doing in the nickel market. A lot of these countries are saying that we don't want to be subject to post-colonial colonialism. As colonies, we were being exploited. And then we become sovereign nations and we continue to be exploited. We still export our raw materials. We're still beholden to the global north. I think we're going to change that. And, Indonesia, for example, has said they don't want to export their tin unless you start building value-added plants in Indonesia. And Tesla has said, okay, we're going to build a large plant in Indonesia. And the same thing is happening in Brazil, and the same thing is happening in Chile, and the same thing is happening all across the global south. And that means once you have to understand more countries, clearly currencies become more important, but because that's kind of like the easiest way into a country.
Right.
I mean, if you think, oh, I like Brazil, all right, well, there's three things you can trade, right? You can trade the Brazilian stock market, Brazilian interest rate market, or the Brazilian currency. And for us macro people, the easiest thing is to trade the currency.
Right.
You can just go and do it. For a retail investor who is listening, the easiest thing to trade is the ETF, the EWZ. You can buy that and say, well, I think Brazil is cheap over the last 10 years. Here are the stories that I think are going to drive it forward. The central bank is going to eventually start lowering interest rates. Inflation is running at 5, interest rates at 13.75. Real rates are some of the highest in the world. As they start dropping rates, there's going to be capital inflows. Stock markets are going to do better. Buy the EWZ. So, I'm long the EWZ, but I'm also long the currency because I think it's going to lead to more capital inflows. Again, an idiosyncratic bet.
Right.
Now, if the U.S. blows up because of some debt ceiling crisis, is Brazil going to sell off a little bit? Yes, it will. But, it can decouple. I mean, we've seen decoupling, and I think over the next 5 to 10 years, we're going to see more decoupling.
Right. And that's therefore kind of people should be looking at different currencies more so than ever before.
Yes, exactly. More currencies, just as a benchmark for more countries, really.
Right.
Like you need to think about more countries in order to build an idiosyncratic portfolio. So I would have, the ETF for Poland in my portfolio if I were a retail investor. It's called EPOL, EPOL, because, I like Poland, and I think you're going to get a currency pickup, but also you'll start seeing capital inflows into Poland. So the stock market there is trading at a PE of something like between 6 and 8, depending on which one of the indexes you look at. It's not very expensive. It's starting to go up. I think it's up about 10% this year. Okay. Seems like a reasonable story. And I think, the election in Poland's not that correlated with what's going on in the US.
That's great. Now, Jim, we're getting towards the end, and we kind of have to, unfortunately, draw this to a conclusion, but we're not going to ask you the regular kind of questions because we've asked them before, but you have told us that you have a Byron Wien surprise for us. And so for those who don't know, Byron Wien is a strategist. So he talks about the surprise, and how he defines the surprise is something that he thinks that the market would assign a less than 1/3 chance of occurring that he thinks has a greater than 50-50 chance of happening. Do you have a Byron Wien surprise for us, Jim?
I would say that, what is being underappreciated in the market is a Ukrainian victory in the spring offensive that is just about to start. I think the general feeling in the market is that the Ukraine and Russian conflict is going to become a stale conflict. It'll just be going on for years and years, kind of like Cyprus, which 50 years later still has that same border between Greeks and Turks. And that will happen in the Ukraine between the Russian positions and the Ukrainian position. But, we have supplied an enormous amount of weapons. Western Europe has supplied an enormous amount of weapons. Psychologically, the Ukrainians are clearly more motivated than the Russian troops. I think the surprise will be that they do significantly better than the market expects. And I think that will be very risk positive. And then we'll see what happens. Of course, in the meantime, we also have our debt ceiling, which could be
right.
very risk negative. So we'll have to see what happens faster.
And do you think that it's I think one of the kind of pushbacks, or not pushbacks, but worries about that would be that as Russia loses, it becomes more destabilizing aggressive in Russia itself.
Yes, I think that's true. And we don't know what a change in Russia would bring. But, I think what has happened in the last 14 months, 15 months has really made Russia a pariah. And in a certain sense, a change in Russia is probably more likely to lead to better relations with the rest of the world rather than worse relations.
I guess it's tough for it to get worse from here. All right, that's a great Byron Wien surprise. And before we let you go, Jim, I hope you don't mind. We'll talk a little bit about your dog. I heard him, I think, there shaking his head. Shaking his head. He's unfortunately got something that I didn't know about in terms of something that's particular to New York City.
Oh, don't tell me that. It's true. He caught leptospirosis, which New York City rats carry.
Right.
It's a terrible thing. And, many dogs die. About 50% who catch it die. This one is 13 years old and has been on pure oxygen for 8 days in a row.
Oh, my goodness.
And looks like he's going to survive, although he looks like a mole rat because he lost all his hair.
How do these poor dogs get this?
It's actually a little gross. The rats carry it in their urine. So,
they smell the urine or whatever.
If your dog steps in the puddle that a rat peed in, and then they lick their paws, that's how they can catch it. Or they eat something off the floor that a rat had peed on.
Oh my goodness.
It's kind of a sad story.
It is sad, but we're hoping. Is he doing well?
He is much better, much improved. Yeah. He cannot hold his liquid all night, so I set my alarm for 2:30, and I get up every night and I walk him, which in a certain sense has actually been fun because I end up looking at the markets around 3:00 and being up from 3 to 5, and then going back to bed and sleeping from 5 to 6:30.
You're a real trooper, Jim. You're waking up to do the dog walk / market check in the middle of the night.
Exactly.
Listen, for those who, I want to thank you again for all your time, your generosity, your kindness. You're truly one of our absolute favorite guests. People, you just stop me on the street and just all tell me about how much they enjoy all your time coming on our show. And I just want to echo those sentiments. And for those who want to learn more about you or kind of follow your work, where can they kind of reach out to you?
Well, two things. One is just connect on LinkedIn. I love being connected. I answer, I share ideas. I've met interns. I've done whatever I can on LinkedIn. And of course, my email is jleitner@falconmgt.com. I tend to answer them. I sometimes miss them. I have about 38,000 emails I haven't read recently.
You beat me. I must say I'm the same way. I get overwhelmed, and I do apologize for anyone that I've missed. I have the same sort of, not 38,000, but it's in the many thousands. And it's like, I feel like just declaring email bankruptcy sometime and just starting all over again.
And, we always do a puzzle, and this time we never got to a puzzle. So I thought maybe I could just quickly mention one.
Sure.
Maybe you could be the person who keeps track of who answers it first correctly.
For sure.
So there is a puzzle that goes 30 minus 33 equals 3. Okay. And how can you make that puzzle correct? How can you make this equation correct? By moving one character.
Okay.
And Kevin, you and I talked about this 6 months ago, and you had an answer and I had an answer, and they weren't the same answer. So there are at least two answers that we saw.
Right.
And, what we decided was that whoever sends in the first correct answer, we will take out for dinner, either in Toronto or in New York.
For those who are interested in participating in Jim Leitner's contest, please send an email to nostupidquestions@markethuddle.com, and please put in the subject line Jim Leitner's contest. Jim, it's always a pleasure having you on the show, and all the best to you and your dog. I hope he's okay. We'll all be rooting for him.
Thank you. And I love being on the show. Happy to come back again.
All right, Patrick, it's time for Talking Charts. What do we got?
All right, well, let's quickly review the top 3 things we were watching 2 weeks ago. It was the U.S. dollar, regional banks, and the inflation numbers. So what's interesting, the U.S. dollar did end up bottoming and going. I mean, we'll talk a little bit more when we settle the bet. But we did get a bit of a bounce in that dollar. The regional banks were selling, but a bit of a reversal the other day. But I don't know if it's all over. I mean, Janet Yellen was talking about that there could be a few more of these mergers coming in the future. Do you have a comment on that?
No, I wish she would keep her mouth shut. Like, we don't need that. It's like negative help.
Yeah. And then the inflation numbers came out. What did you take away from those?
Not much. I think for the first time we've had an inflation number with little market reaction. It's finally gotten to the point where it's not the most important thing, and that the market is being able to forecast proper inflation. So this is what we need. We need it so that those aren't market moving events. That's not the volatility around that number has been way too high, and as it comes down, it's a good thing all around.
All right. So the top 3 things to watch over the next 2 weeks. Number 3, big tech. I just wanted that melt up it didn't come out of nowhere. I mean, they were the strongest sector. This is the NASDAQ, but it just picked up and just blasted off out of that 1 month consolidation. But really, NVIDIA and all of these others just accelerated to the upside, and the breadth of the market still staying relatively weak. And so once again, all these breakouts that we're seeing in the S&P 500 and everything, it's all once again being led by these mega cap stocks. And so for me, watching whether or not the run out of fuel and peak out is certainly something to watch for the next 2 weeks.
I think it was interesting, Patrick, because we used to talk about whether if we had a breakdown in the FANG mats, whether the stock market would be able to hang in there. And it ended up being the opposite this year. It was an absolute explosion of the FANG mats, and everything else looks like shit.
Exactly.
And I'll tell you one trade that I would have one chart that I would have never imagined in a million years of occurring is if you pull up the NASDAQ over the Russell 2000.
Yeah.
And we are now at a stage where...
this is the Russell NASDAQ, not NASDAQ Russell, but yeah,
go back and look at it over a longer term. Kind of, can you go back all the way to 2000? And you'll see that this was
this goes back to only to 2018 on this chart.
No, unfortunately you can't. But we had this move in 2000 where the NASDAQ just took off, and it looks like if you're doing it the other way, it looks like an Eiffel Tower formation. It goes straight up, straight back down. And then we've had, obviously, the rally of the past, 4 or 5 years where the NASDAQ just keeps outperforming Russell and Russell and Russell. Yeah. And it just, I would have just never thought that after 2022, when it broke and we saw the big weakness in those big cap techs, and it looked like that kind of the bloom had finally come off, the boil had come off the bubble. And I just would have never thought they could have blown it, but it looks like they have.
But you know what? This entire run on the upside, I mean, push back if you don't agree with it, but it's been multiple expansion at a period where, it's hard to justify these multiples with such high interest rates. I mean, this is...
Well, first of all, I guess that just shows you that relationship that everyone thinks that PE higher rates means lower PEs isn't the case. And if you go back and look at that over a long period of time, it actually doesn't work. It's kind of random.
Yeah, I mean, the market just you buy what's hot because it's working is the
I really think it's this AI.
Yeah.
It came out of nowhere. We saw 3 big, hedge fund legends talking about how transformative it was in terms of their expectation of not just the stocks themselves, Patrick, but the whole macro landscape. And that was the part that really caught me off guard, was that we saw Stanley Druckenmiller, Steve Cohen, Paul Tudor Jones talking about how they expect a return to disinflation because of the big boom in productivity from this AI. Now, I'm a skeptic. I don't think that is going to be as transformative as they think, but it doesn't matter. In the meantime, that's what's occurring. And so we see people rushing back into the old trades, which is long big cap tech and basically long rates,
right?
Long bonds, because they expect disinflation to come back.
There you go. So number 2, let's keep moving here. In 2 weeks, when we're recording the next show, we'll already have seen the June 2nd jobs numbers. So obviously, there's a lot of leading indicators that are suggesting there's economic slowdown. But I think the one thing everyone's waiting for is that jump in unemployment, something over 4% to really indicate that potentially the jobs market is cracking. And so I think watching whether or not June comes in line or whether we see weakness is certainly something to watch. You think this June number will be important?
Well, the jobs number is obviously always important because we're kind of just on pins and needles waiting for the actual first signs of the kind of layoffs to hit the actual kind of official numbers. But whether this is the one where it kind of clicks in, I don't know. I've given up. It just doesn't seem to be like, maybe that's the best sign that it's coming.
Yeah.
But it's been one of those things that just continues to confound everybody.
Yeah. And so number 1, we have to watch about this budget deal. And obviously, I think obviously the headline today was, that Republicans walked out, but I think that's politics and posturing. But do you think that this is inevitably going to get done, or you think that this is an increasing chance that there's a stalemate here?
Well, so it's most likely going to get done because, let's face it, even if you believe that there's a 1/3 chance of them technically defaulting, that still means that there's a 2/3 chance that they don't and that we have a deal. So even if we have a situation where you are more pessimistic than the market expects, you're most likely still in a situation, there's still a scenario where it's most likely going to happen in terms of there will be a deal. But does that mean that there's that chance that the market is expected in terms of, if you look at the CDS, they're pricing in a 4% chance of it occurring? I'm with Jim Leitner. I think it's much higher than 4%, whether it's 10, 20, or even Jim suggested 25. I don't know. I just think that there's a better chance than the market expects that we do have a default of some sort.
So then the question I have for you, though, I think, which is the more important one that our listeners care about, is that, okay, let's say there is an announcement that there's a deal. So the 2/3 versus 1/3 happens. Does the market bullishly blast off from that? Do you think there's enough pent up nervousness and money on the sideline that would be put to work if a deal came through? How do you think the markets react?
That's a great question. Obviously, the initial reaction will be up to buy it. And I think it'll also depend, Patrick, if we have a week of us going up ahead of that time. Let's imagine next week we rally for another, 150, 200 points because of all the kind of soft words we're getting or nice words we're getting from the politicians. Then we could have a situation where on the actual deal announcement, it's to sell the news event.
Yeah.
But if we have a situation where there's lots of worry and we're selling off, then I don't know. It'll be different. It depends on the setup.
Yeah, I actually am of the opinion. I wanted to hear yours first. I actually don't think that the first reaction will be up. There's that's going to be just a natural expectation. But the fact is that the market hasn't been nervous about it. I mean, we haven't seen direct selling out of nervousness associated with this debt ceiling thing. I mean, the S&P 500's at multi-month highs, right? There's no sign. And so it's not like it's oversold and there's all this pent up energy to create a reflexive rally. Instead, it's pushing up along the highs. I really do think it rallies on the first reaction and then fades the other way is my anticipation.
I think the other thing, Patrick, that you need to think about is what is the deal? If the deal involves a whole bunch of fiscal cuts, then I think that'll be a much different situation than a deal where they just agree to extend the debt ceiling and push it all off.
Yeah.
Because in 2011, the market sold off after the deal was announced. And the reason that it sold off after the deal was announced was because there was draconian budget cuts that Obama had to agree to.
Yep.
And if we see a similar situation where the Republicans manage to get the Democrats to agree to a lot of cuts, then we could see a situation where even on a debt announcement, a debt ceiling announcement of a deal, we have a situation where the stock market still sells off.
There you go. Okay, let's talk some charts, bud. Let's start off here with the S&P 500. Actually, I want to talk about the equity markets in general because we started with looking at those super strong mega caps. So let's actually have a just quick tour of all three of the mega cap or all five of the mega caps. Like you look at, let's start with Meta, which continues to just press in higher highs. Every dip is being bought. You take Amazon, basically making a fresh high, a little bit of a reversal today, but really moving. You take Microsoft, just pressing new highs. Just look at this chart. It's beautiful. Like every single one of these pushes just keeps advancing. Then you have Apple making new highs. So this is where all the buying comes in. Actually, I'll just show Nvidia as well, which has just been so strong. So all these have been carrying the market. But then when you look at the NASDAQ, you can see where that strength is coming from. But the breadth of the market remains incredibly narrow. So I like looking at this chart. This is the percentage of stocks that are trading above their 50-day moving averages for the New York Stock Exchange, right? So, and you look here, we have only 48% of stocks above their 50-day moving average. That means half of the stocks on the NYSE are actually in a downtrend. And that's in a period where almost all the major indices have been pressing higher for almost 5 months, 6 months, right? And so the interesting thing that I'm thinking, Kevin, is okay. one of two things. Either the FANG stocks just run out of gas at some point. It doesn't mean they can't go higher on the short term. I'm not trying to say that this is imminent, like any day or something, but either they run, like they're blasting off like rocket ships into the sky. At some point they run out of fuel and gravity was going to drag them back down. But the other question though is the other pent up energy that could come in is that the breath returns. Like the rest of these stocks just have not participated. That if some kind of fuel sparked a broader market rally, then really that could be the only scenario that I see that really legitimately takes the stock markets higher. But here we are with waiting for the most anticipated recession in history, and we're in an environment where the Fed has raised interest rates historically fast on the upside, and the stock markets are in this position. It's such a bizarro world, isn't it?
It really is. What's your feeling about the chances of the market broadening out and actually rallying kind of across the board?
I don't sign a high probability because I think the monetary cycle and the credit cycle and business cycle matter. There's a reason the vast majority of stocks are sucking wind is because there isn't a broad return of earnings growth in any way. Like I find the last earnings cycle wasn't a horrible one, but if you think about what legitimately drove the stock market expansions in the last several bull pushes, it was substantial earnings growth, and there's no sign. And do you really in this market environment believe that these companies are going to see that kind of a push? I think that right now what's happened is that there's a scarcity of capital, and it's all been concentrated in creating this feedback loop on the mega cap stocks that has become almost like that Giffen good, feeding on itself higher. I don't assign a high probability to the breath returning in a big way.
Yeah, I think that's a great analysis about the feedback loop occurring.
Yeah,
because it's almost like the weakness of the economy and the stock market is causing people to go into the more narrow kind of those big cap techs, because they've generally done well in that environment of low growth, moribund kind of economy.
And I also think that a very large amount of market participants, whether you're a hedge fund manager or a money manager or anyone, you're being judged on your performance. So you have to own the things that are working. You can't be a value investor here holding shit just on valuations and then watching all your peers outperform you. You're going to lose assets under management. A lot of people's money managers' returns are based upon their performance, so it almost creates the herding into the same stocks that are working.
Yeah, it's a great point.
And anyway, but it's when and how this. I still think that the stock market is in a bear market, and I still think that I don't know if I want to be doing some sort of doom at 11 o'clock thing you can insert here, but I do think that there's another leg inevitably for many stocks down lower still later this year. How low it goes, we will kind of do the play-by-play on the show, but I still think that as soon as we see some sort of maybe some catalyst has to emerge. Maybe it is something like when an uptick in the jobs number, something that recession is verified in some way, and maybe that's what breaks it. It's like the old saying that nobody cares until everyone cares, and then they all care at once, right? And it'll be one of those scenarios that no one cares right now, and then suddenly one thing will just appear, and then the sentiment in the market will completely shift.
Well, and the other thing that we haven't spoken about is that if we do had a debt ceiling resolution, they would go and they would issue a lot of new T-bills / bonds and notes because they've held back, and they want to replenish the TGA. And if that was the case, then that would be a liquidity suck out of the market, and we could see a situation where that's actually a risk-off event as well.
Yeah, well, that's actually never thought about it that way, but you're bang on. That's a great point, Kev. All right, so listen, let's talk some other charts. So it's the dollar pops here a little bit off of the support line. It's actually this 104 level on the dollar index is important in my mind because it's the 50% retracement zone of the prior drop, because reflexively rallies happen all the time in counter trend. So the question here is this a level right here around 104 on the dollar index where the dollar stalls out and heads right back to the lows? Or are we going to see a far more neutral price action where we see a new trade range where the dollar index, let's say, rallies to the top end of the range, then back to the bottom of the range, and breaks this pattern of this downtrend and finds sort of like a pocket where it's trading? I've been far more neutral to currency markets than I have in the past. And I don't really have that strong of a conviction either way. I do think that in a risk-off cycle that the dollar will behave in its traditional manner and have an advance of some sort. But do I think that there's another monstrous dollar leg higher? I don't think so. And so it'll be interesting to see right here whether this 104 level rejects the dollar, at least in the coming weeks. Is there anything you're watching?
Well, what I think is interesting is the kind of dilemma about whether if they did have a default, whether people would rush in and buy dollars, as you mentioned, that's traditionally been kind of a risk-off kind of response, yet you'll be buying the asset that is defaulting, the country that is defaulting. And I think that is strange. We've never had that before. So I would be hesitant to say that's definitely going to happen, because the reality is we don't know what's going to happen. We've never done this.
Yeah, it's good. Yep, I'll agree with that. What's interesting is that U.S. dollar yen, though. The yen has been so weak. The U.S. dollar has now broken out of those March, April, May highs. And at least the U.S. dollar is strengthening quite a bit there. And the other currency that's happening is that U.S. dollar renminbi, where it's broken out to 2023 highs against that. So we're definitely seeing the U.S. dollar strengthening in a few of these Asian currencies. Even though the euro has pulled back a little bit, it really has been these Asian currencies that have been much weaker.
Yeah, I don't disagree. It's been disappointing in terms of the yen. I would say that relationship of like yen being a risk off currency is kind of resumed, and as we had the risk on event, we see the yen weakening.
Yeah,
and like I noticed that the other day when I was looking at the AUD JPY, which is traditionally been something that you watched as a kind of an indicator for the S&P 500. And that relationship had disappeared in 2022, but I've noticed that recently it's been coming back, and I think that it might just be that the yen is going down because we're having a risk-on event.
So what's interesting as well, since we're talking Japan, what a move on the Nikkei. Like, that Japanese stock market's been on fire. And what was interesting about this move is that this is a multi-year high, or is it an all-time high? No, I don't think it's an all-time high. I'd have to look at it monthly. But like when we made these 2021 and 22 highs on the Nikkei here, we saw just here on Friday, when we were recording, a break out of multi-year highs. Like now, I don't like parabolic rises. It's not like I'm saying we should start buying here, but boy, has this been one of the hottest markets.
I continue to love it. It's been one of my favorite trades, and I love it. I love the 1615, which is the bank ETF as well.
Yeah. The other one you love is that Mexico trade.
Although that one's had a tough day Friday by the looks of things.
Yeah, well, I mean, after having a multi-month advance when this ETF went from like 53 to 63, which has been a great run, the rallies are going to get checked, right? And so I don't think that a one-day down day like this is something to get overly nervous about. I mean, we could easily see this pull back to $59.60 still base and continue higher. That's just natural, but it's been a great trade call that you made on this one, and it'll be interesting to see whether the dip gets bought on this one as well.
Well, it's nice to see you get something right every now and then.
All right, let's quickly touch on a few commodities. Number one, crude oil. So I wanted to just quickly touch on this is the July contract. And what's interesting to me about crude is this area right in here is what I call what is the high volume node consolidation area, which is an area where the vast majority of the volume traded for the last year. And what's interesting is that with this breakdown in crude oil, it's now resting below these levels, continuing to demonstrate the bearish trend is still the dominant one. And while we did bounce off those incredibly oversold levels, this is, in my mind, a real make it or break it moment for crude. If the oil bulls want to save this, they gotta get it back into the mid to high 70s really quickly and neutralize the price action. If crude oil fails here below $74, $75, and let's say the jobs numbers start showing some sort of recession crack, well, this could not quickly find itself back down to those May lows and even make a lower low. While I am an oil bull in the bigger picture, this chart, it looks like shit, bud. This is such an important moment to see whether or not the oil bulls can put something together.
I think the oil bears have gotten ahead of themselves. But I do want to talk about one thing. I so desperately want Biden to get his crude oil back, to get it back in. Because I consider him short here. But just kind of put politics aside. So many market guys thought that he was going to make a mess, and they thought it was a terrible move and stuff. And it just would make me laugh so hard if he ended up having one of the greatest trades of all time by selling the SPR at 110 or whatever it was, and managed to bring it back in at 75. It would just make me laugh so hard.
Well, what would make me laugh even more if he brought it in at 60?
I guess so. That would be even better.
That would be the epic trade.
I think he's playing with fire, to tell you the truth. I think that he needs to bring it back in. He has the size that he's trading with. He should just stand in there and iceberg this thing at $72 or whatever it is, and buy it, bring it all back in. Yeah. And that's what I would suggest to him. It worked. It was great. But at the end of the day, that there's a word. It starts with strategic, and I think that it's important to have it. And it makes me a little nervous when they start using it too much for politics.
Yeah,
and it was probably already a little bit overplaying his hand. And whenever traders get cute and start killing bids, which is what it looked like he had done, I just thought the market's going to teach him a lesson, and it's going to rally without him. And that's what I still, at the back of my mind, what I'm still worried about.
There you go. So wanted to talk briefly about Dr. Copper. And Dr. Copper's a little sick. And what's interesting is that there was every chance back in March and April for copper to bullishly turn up. And with this breakdown here, it's really clear that it's advertising that we're going into some sort of economic slowdown. We don't have to call it a recession, but clearly this is not where the demand is coming in. And what's interesting is that with this kind of weakness, the bigger question is copper have a date to retesting the 2022 lows? I mean, this is such a distributive chart, lower highs, lower lows. I don't know if what's going to come in here to save the day on the short term. Obviously, I subscribe to the commodity bull super cycle. I think that going into the years to come, there's going to be plenty of bull market moving forward. But really, the question is, what happens in the next 3 to 4 months? What is the tactical short-term trade? Where are things going to settle in? To me, this is still an incredibly weak chart. May lead to some really amazing buying opportunities later in the year, but no sign of a short-term bottom here.
One of the things I thought was interesting was Stanley Druckenmiller had a couple of speeches recently, and he talked about copper And he spoke about how he thought it was setting up from a long-term perspective as being one of the greatest trades of his career. But for all the reasons you just mentioned about the recession or economic slowdown, he's hesitant to buy it. I wonder how much of this decline is the recessionistas putting on the trade of shorting copper. And I also wonder is even with oil, it's just you pull out the playbook. If you think the economy is going into a recession, you sell copper, you sell oil.
But I don't think it's just traders, though, Kev. I mean, I actually think it's economic activity, right? Like, when you have huge fiscal spends and you have a robust economy and you have cheap money, then there's huge projects that go underway, and the demand for basic materials increases. And so when you're trying to fight inflation and you cut liquidity and you slow everything down, the demand just goes down. So saying that it's just trader driven, I'm not so sure I'm going to drink that Kool-Aid. I think I think they call it Dr. It's Dr. Copper for a reason.
I don't know. I'm going to take the other side of that. I think that the financial bid or offer in both copper and oil is much larger than folks realize.
Okay.
Meaning that the financial the traders that are moving it around for financial reasons are at the margin setting more prices than we might guess.
There you go. All right, but I think that's enough. Was there any last chart you wanted to touch on?
No, that sounds great.
All right, let's move on because we have to settle up skin in the game, bud. What a bet! Like you go and try to nail me with this one touch Euro USD, and I didn't bite, and I wanted to, and I went Costanza on. I'm like, no, he wants me to take it, so I'm gonna intentionally do the opposite.
So wait, you only didn't do the trade because I wanted you to do the
exactly.
Trade?
Isn't that horrible?
And that you were correct.
Yeah. And it ended up coming in like one touch. It's funny because the euro did hit its low was 107.62, so it did break below that 108.01, and this was such a great bet, and it was only 1 point.
I know. Well, it's because I can't bring myself to be like. Bearish.
All right, why don't you tell people about the game and and you can make it.
Skin in the Game is our weekly opportunity for us to demonstrate that we are degenerate gamblers at heart. Every week, one of us presents a wager, and the other guy chooses which side of the bet he wants. Every wager needs to settle by the next 2 weeks, and we play a match to 50 points. What is the score right now?
It is you back in the lead. We were tied at 34.
Back in the lead, and we're playing to 50. We're getting closer and closer. And I got an idea. This is what we're going to do for this one. Because it's my turn to make a bet. We're just like last week. The U.S. 10-year.
Okay.
And we're just going to do nice and simple. I'm not going to try to bamboozle you with some option pricing. We're just going to do 10-year yield up or down.
Straight up, eh?
Yeah, straight up.
I'm gonna take yields down.
Okay. And how much you want to do?
4 points.
Oh. Okay, you're on.
Love it. I get it. Like there's all sorts of this TGA and debt ceiling stuff in there. 4 points. Let's do it.
You're already done. You bid, buddy.
It's already done. It's already done. Okay. So 10-year treasury yield, higher or lower? By the way, the number is 367.8. Oh, 367 spot.
Okay.
All right.
All right.
So this is where Lena saves the show with no stupid questions.
Things are getting exciting. You guys are betting more points.
Yeah. Well,
I'm at the edge of my seat.
Yeah. You sound very enthused about it all.
Well, 1 point was like, so 4 points is exciting.
There you go. All right. Okay, right. So what's the first question, Lena?
So first question, this listener is Canadian living in Germany. Good morning from Germany. I love the new MH+. We hear a lot that as there is more QT and more total government debt, that there will be too many treasuries and a blowout in yields. But as yields rise, investors will come back in their risk curve to treasuries, putting a ceiling on treasury yields. It seems that all of the risk of yield blowout should be in riskier investments such as high yield and junk bonds. Why wouldn't you play the trade that way rather than short treasuries? Many thanks.
Well, Kevin, I you have a lot to say on this, but first of all, I don't disagree, because I think that as the money is soaked up in treasuries, it's the scarcity of capital that will inevitably have to create higher credit spreads on the junk. And I think one of my favorite things to watch, even though I haven't expressed it as a trade, I continue to watch for inevitably a breakdown in those junk bonds as a canary in the coal mine for potentially another risk off cycle. And so I'm definitely watching that. But what's your take on this?
Well, I'm going to actually agree with you, Patrick, which is very unusual, especially when it comes to bonds. But I've long held that quantitative easing, even though everyone thinks that it's bond positive, it's actually bond negative. And if you think about what quantitative easing is designed to create, i.e. inflation, that's actually a long bonds investor's worst nightmare. And if you think about the opposite, which is quantitative tightening, it's designed to slow down the economy. And if you slow down the economy, that should mean that there's less inflation, and therefore that's the long bond investor's best friend. And so I'm with you. I actually think that quantitative tightening is not something that means that you should go out and be buying or selling treasuries because of it. It has more to do with creating actually a risk-off event, which I think will ultimately might be positive for treasuries.
There you go. All right. So the second question.
Well, this is a long one. Dear Lena, Kevin, and Patrick, forgive me a rather unsophisticated question. I am getting crushed on some long-dated put options. I'm sure my thesis is correct, just the wrong timing. Anyway, if you want to cut your losses and get out of a bad trade, what signals would you use for a stop? For example, percentage loss on the option, percentage loss on the option relative to the time until expiration, percentage gain on the underlying security, some combination of all of these. Could you give me an example? When is really the deadline to get out of a bad long-dated trade? Like at least a month before the expiration? And as a related follow-up, what books or resources would you recommend to become a better educated options trader? Many thanks for all. I really appreciate the genuine nature of your interviews and interactions. You have a great team.
Oh, well.
So can I just say, I'm going to let you do most of this, Patrick, because this is definitely your stuff. But I will say that one kind of the first thing that in terms of answering most of these questions, you should know those answers before you enter into a trade.
Oh yeah, I mean we talk about it a lot of times in a lot of our programs, but Kev, like for me, when I make a thesis, like for instance, the stock market's going to decline, right? Something that this listener did, I have to know on the charts or somewhere where I'm going to admit I'm wrong, and I don't look at the P&L of the actual option. I look at whether or not my thesis about the trade is right or wrong. And the option is just a tool or a vehicle from which I'm expressing the trade. And so when I put on an options trade, it's actually my way of putting on a risk managed trade. I'm defining the risk. I know exactly how bad my loss can be. It's where I'm getting the convexity that I'm looking for. And so I don't look at the trade and, my option's down 30%. I have to get out. The option is already sized in my mind the way I need it to be to express the trade in the notional size that I want it to be either long or short. So I don't really use any of those metrics that he's referencing in here in terms of like a percentage of loss on the option or the percentage gain on the security. Like I wouldn't say, if the stock market's up 10%, I'm going to get out. I literally construct the trade in advance and know what I'm looking for the criteria that the trade is not the trade I was looking for, right?
Right. And I just think there's so many of the gurus who will all say the same thing, which is that you should know where you're getting out before you get in. And there's something to be said. That's your decision is going to depend on your risk tolerance. It's going to depend on your feelings about the trade. It's going to depend on so many different things. The only piece of advice that I would give is that you should know where you're getting out before you get in.
Yeah. And just a shameless plug in terms of books or recommendations. If you do a free trial of Big Picture Trading, there's a whole bonus content section in there. And you can watch a whole bunch of videos on different things inside Big Picture Trading that helps you learn about these things. Shameless plug. Why not? Right.
There you go.
Lena, help us with the next one.
Okay, next question. Stanley Druckenmiller recently said to swing really big when you see a fat pitch. That makes me think about how one would identify a fat pitch. Can each of you give an example of fat pitch you identified and swung big on? What gave you conviction at the time? Additionally, are you envisioning any particular set of market conditions that would shape up a fat pitch in the next 12 to 24 months? P.S. The Market Huddle plus short interviews have been a great ad.
Oh, that's awesome. Okay. Go for it.
Do you want to go, Patrick?
Sure. Well, for me, like the thing for me is I only swing for fat pitches. He's
a home run hitter, folks.
No, but listen, I strike out often, right? Like it's not like, but the thing is for me, is that I build asymmetric trades when I see these things. I like to be concentrated. I don't really like to be over diversified. So I look for high conviction ideas and I go with conviction into them. And for me, the way I build asymmetry in the trade is I construct the trades through options where even though I'm swinging big and I have like all of that gamma on the upside, I'm trying to construct the trade in a way that it doesn't, I don't lose a limb if I miss this pitch, right? And so I do love swinging for those bigger ones. It's one of the things that I love to do, and the big thing is that you always want to find these great ideas, but you're looking for where are those moments where you can define the risk, manage the risk, and if you're right, there's that big upside potential. And I think like a good example of that is this past year, I took a big swing on gold and I took a big swing on oil. One of them made me a shitload of money, and the other one was a disaster. And in the end, the oil trade was a paper cut for me. It didn't work, but I didn't lose my shirt on it, right? And that's I think the key way to approach it. What's the way you do it, Kev?
Well, this is something I've struggled with for many, many years. Stanley Druckenmiller is like a hero of mine. I think he's the greatest trader that's ever lived. I always thought that, I think he was the one who said something to the effect like you get up 30 or 40% and then you can swing bigger and you can get up 100%. And for me, I guess it's one of these things where you have to get to know yourself and figure out what works for you. That's never worked for me. Whenever I start swinging for big fat pitches, I start trading wrong, and it ends up being, I make a mess. So I'm much better just kind of being a base hitter and just, getting around the bases that way. And I've given up trying to go for the big fat pitches and waiting for them because I've just haven't been able to master that skill, and I don't know if I ever will. So one of the things I would just say is be careful when you're kind of assuming that just because one of the greatest traders said that this is how you do it, that's how he does it. It doesn't necessarily mean that's how you have to do it.
Right. All right. So, Lena, where can they submit their questions?
So if you have any questions for Kevin and Patrick, please submit your questions to nostupidquestions@markethuddle.com.
All right. So thanks for tuning into the Market Huddle. We appreciate you spending some time with us. Please give us a follow on Twitter at the Market Huddle. We're there every day. You can listen to Market Huddle on all the networks: Google Podcasts, Podbean, Spotify, Android Play, iTunes, and YouTube. A lot of people watch on YouTube to see all of our charts and visuals. And while you're there, please like and subscribe to get our latest content. Patrick, where can they find you?
You can find me at bigpicturetrading.com or follow me on Twitter at Patrick Serezna. And Kev, where can they find you, buddy?
Well, you can go check out my newsletter at themacrotourist.com, and you can go macrotourist.com/chat to go and join our group on Substack. It's a great group, and we really, more the merrier, and we're just happy to have everyone there. So listen, we can never have too many friends, bear market, bull market. We're just happy to spend some time together on this crazy ride. So now stick around for the after show.
I love this beer.
Oh, you do you?
Actually, I do.
I
always love to have lady friends, so this is perfect. No, but you know what? It's a great IPA, bud. Like I love it. It's I love it.
What are you giving it?
An 8.4.
Oh.
8.4. 8.1 for me.
8.1. That's still pretty high.
Yeah,
for you?
Pretty high.
It's a good beer.
It's a good beer. I don't know if I like it as much as Patrick. I think Patrick's been drinking into a little bit of beers lately, and he's just enjoying anything that's beer like.
I think.
By the way, someone was telling me someone reached out and said Patrick's sounding really rough on the other podcasts that you cheat with.
Rough.
That's what they said.
Rough.
Like
said, is he hungover? And I said probably.
Oh.
He is probably hungover. That is probably what's going on.
Wow. I can neither confirm nor deny this. All right.
So, anyone have anything interesting they want to share with everybody? Share with the group?
Well.
New TV shows, things that you're doing, places you're at.
Well, Lena's out in Lisbon, so we've gone out, checked out a couple great restaurants and stuff like that. So it's great to
the Market Huddle, the Market Huddle piss up in Lisbon.
I need a new liver.
By the way, speaking of Market Huddle piss ups, I completely forgot to thank everyone. So first of all, a big thank you to Harris Kupperman. For coming and hosting and taking care of the bill. He picked up everybody's beers, and we had an absolute terrific piss up. Big thank you to everyone that came. We had George came from Vancouver. He actually flew in for it.
Wow.
We had some terrific ideas. You had to audition to get onto the into the group, and so we had some people presenting some different ideas. So it was really fun that way. It was. The venue was very interesting. It was at the Imperial Pub. Do you know where that is, Patrick?
No,
Imperial
actually,
Pub.
don't.
I think it could be one of like a part. It's like the Wheat Chief before the Wheat Chief got nice. It was, but it was a real lot of fun, and it was terrific to actually everyone got an opportunity to ask Harris some questions. We had a mic, and we went through Q&A for it must have been an hour and a half, 2 hours. Like, it was just terrific. People got to ask their questions. Lots of doom porn in the audience. I must say, I thought that we were going to get lots of kind of less doom porn, and they were definitely your crowd, Patrick.
Oh,
they were definitely your crowd.
That's and that's because they're all like Torontonians.
No, there was one fellow I can't remember. I wish I remember his name, but he was an insolvency expert from New York City, and he was just like he had the full-on doom porn kind of going on. And I must say, lots of people came up to me afterwards and said, the insolvency expert, he had a good story. It was sure sounded good.
Well, you know what? I do enjoy the doom porn.
You do. I know you do. I know you do.
There's inside of me is this little bear that I keep kind of trying to keep a leash on. And it's like, just trade. Don't let the bear win. But it's in there. It's in there.
Do you see how much being full on Doom at 11 cost Carl Icahn?
No.
Oh, you didn't hear this story?
No. I saw some headlines, but what was the number?
Let me figure out how many billion it was. There it is. Carl Icahn bet on America to fail. Instead, he lost $9 billion. Remember when he used to have that web page? Like, he had his own web page for the market kind of crapping out. Like, it was, you go to his kind carlicon.com, and there would be like this whole thing. Let me just see here. Let's see if it's still there, because it used to be. And oh yeah, it is. No, it's gone. It's gone. But if you used to go to carlicon.com, it would basically be this huge, like, full-on doom porn site, and it would be why he has the world's biggest CDX trade on.
What if it was Ackman that squeezed him on it?
Well, no, because listen, this was the whole thing. Like,
I'm just kidding, right?
He was bearish, and this was even pre-COVID. He was super bearish and kept thinking that the economy was going to collapse, and that CDX trade, meaning the credit spreads, were going to blow out. Like, he's been really bearish for a long time.
You know what though? The one thing I've learned about being a bear is you have to be patient, because you can always justify why it should happen right here, right now. But what is amazing is how long the market stays irrational. You can say, oh, it's expensive, it's overvalued, it's this and that, but that doesn't mean that it's a good short. You have to wait for the window, to open for you to really take on a short position.
But how often is that window open?
Not often.
And so why bother having that bias?
Well, I think it's important, because I think that what destroys the most people is the people that don't know how to be risk managers. And the only way to be a good risk manager is to always look at what can hurt you. And,
well, I would argue that the Carlicon's short on this America.
No, that wasn't being a risk manager. That was being a speculator, betting that the market was going to break before it broke.
I guess so, but if the market goes up, 8 times out of 10, like, why? I'm not trying to say you should, leverage up the long side, but there does hit a point where you're just like, why am I bothering fighting this?
Yeah, no, listen. This is the after show here, but this is not.
we're talking about markets. We shouldn't be talking markets.
Yeah, we shouldn't be talking markets. Let's save this one for next week's show, because I actually think that this is a great conversation. But generally, you have to be very intuitive as to when to strategically put shorts on. You just can't always be short.
Yeah, I completely agree with you. My only point is that there's lots of doom bears that have cost people just as much money as the perma bulls. That's my only point. Oh, yeah. And I'm neither one. I'm like you, and you know what? You're not even a doom bear, because even though you have a tendency, at the end of the day, you go with what the tape tells you.
Yeah.
Right. So
I like being right.
Yeah. No, I understand. You like being right more than you like being a doom bear. Yeah. And you're the first one to say that. You're just and I completely get it.
Yeah.
And I know all the bears will be like, "Oh, this is it. This will be the top." Listen, because Kev's talking this way.
All right.
Anyways, Lena, have you watched any good shows? Nothing?
Oh no, I've been in Lisbon. I don't have time to watch TV.
You're too busy partying. And is Lisbon rocking as it ever been?
Oh, it's beautiful. Perfect weather. Great
is
people. It? Yeah, perfect weather. It's like 25 to 27 degrees every day. Sunny. Nothing to complain about. I might need a new liver after seeing Patrick for a couple of days.
Okay. Well, I'll let you guys go because it's Friday night.
That's right.
You guys probably want to go back out, even though it is like midnight. You're probably still going to go out drinking.
All right.
I can deny nor confirm that.
All right, everyone. Have a great week. Take care.
Take care, everyone.